How do you like change? If you're like most Australians, you probably prefer the certainty of the status quo. But there are some important changes taking place in our property markets that all investors must understand. Hi, I'm Michael Yardney, and you see there's a number of interesting things going on in our markets, and a lot of it has to do with our levels of confidence. Firstly, we're not moving houses often. The average Australian homeowner now stays put for 9 years according to RP data. That's up from about 7.5 years a few decades ago. It's much the same for apartments. The average holding period has risen to 7.7 years from about 6 years of staying between moves about 12 years ago. RP data research analyst Cameron Kusher puts it this way. He says it appears that homeowners are increasingly likely to keep their current properties rather than upgrading due to the significant cost. He believes that one of the reasons for the drop in home turnover is that affordability remains an obstacle for many would-be home buyers. Mr. Kusher also blames high stamp duty for making homeowners less keen to change their residence. Now, I think there's more to it than that. As I see it, when we feel wealthy, many of us like trading up and buying a bigger, more expensive home, even if we don't really need the more space. It's a great feeling when the property booms make our home, our castle, increase in value. On the other hand, in the current markets where the price of average homes, in some cases they're falling a bit and at best they're remaining flat, at those times we tend to stay put. And if we need to upgrade or improve things, we're more likely to renovate our properties. According to RP data, Melbourne led the national average time. People are staying there about 10.4 years. In Sydney, the average holding period was about 9.8 years, and Brisbane was about 9 years. In Perth, they stayed about 7.9 years, Canberra 8 years or so. The other big change that's happening is we're saving our pennies. We're paying down our credit cards. Rather than using our home as an ATM, we're paying down our mortgages as well. And we're renovating rather than moving houses, as I said. I remember when property analyst Michael Matusik put it really well. He said we're becoming more prudent. But this sort of mindset comes at a cost. Property sales are down, people aren't selling their houses as much, and property values have fallen a bit. Michael Matusik explains that in addition to being prudent, we're buying different things. We're buying services, not goods. He suggests we may already have many of the goods we really need, but as a society, as we're ageing, we end up using more services. This is already showing in the health sector where the employment's grown significantly. In fact, it's grown twice as many jobs over the last year or so as the mining industry has. It's also affecting our construction industry. Despite Australia's property growth and our increasing population, our prudence and the fact that we're staying put in our houses for longer has put the construction industry into a bit of a tailspin. The HIA recently reported that housing starts, which I see as a forward-looking indicator into building, they've actually plummeted about 12% over the first quarter of this year. This makes housing construction the worst performing sector of our economy. I don't think it's likely to pick up this year, despite the recent fall in interest rates and the fact that we're going to have a few more falls in interest rates. All these changes are also affecting property investment sentiment. In a recent report entitled Households' Appetite for Financial Risk, the Reserve Bank noted that a change in household behaviour was occurring towards investments, including property. They found that there's a significant increase in the share of people who were putting money into deposits and paying down their debts. They saw that as a wise way of doing things rather than investing in shares or property. So what should a property investor do? Look, property cycles, in fact all cycles, economic cycles, are driven by fear and greed. While it's important not to trivialise the extent of the changes that are occurring, it's equally important to remember that every cycle brings downturns and then times of opportunity. In my experience, difficult economic times often offer outstanding opportunities for those who are prepared. Now, if the end of the world as we know it merchants are wrong, the doomsayers are wrong, and they always are, then your decision to take prudent action when those around you are fearful And if you invest when everyone else thinks it's crazy, you're probably going to be proven to have great insights in the future. Now, I don't see us as having a property crash in Australia. It's not going to happen. Our economy's doing well, interest rates are low and dropping a bit, our population's growing, unemployment's low, which means everybody's got a job, they can pay off their mortgages, our banking system's sound, and we've got the beginning of a great resources boom. It's not going to end. The resources boom is going to continue. The growth phase is going to slow down a bit, sure. All that means we're not going to have a property crash. Unfortunately, the current world economic problems are not going to go away quickly, and we're entering a new era in the financial markets. But it's not a time to panic. It's definitely not a time to make rash emotional decisions. It's a time to learn from history and control your financial future by investing wisely. And guess what? While the optimists and the pessimists and the realists are going to argue whether the glass is half full or half empty, the opportunists are going to drink from it. Now, if you really want to get ahead and take advantage of the property cycle and not be left behind, I recommend you join me for 3 days at my annual Property Renovations and Development Workshop. I hold it once a year in October. It's Australia's longest running 3-day property training. It's Australia's longest running advanced property training, I guess. It's powerful 3 days to learn the renovation and development strategies used by experienced property investors. So if we've got flat markets in the next little while, what you can do is manufacture capital growth. You're going to manufacture strong rental returns as well. That puts you ahead. So if you're interested to take your property investment to a whole new level, click on the link at the bottom of this article and you can find out all about our property workshop. Look forward to sending you your next update in 2 weeks' time.